higher the risk does not mean higher the return in mutual fund most of the times. So if you are in the lesser than 12.5% tax, then only your debt fund FD makes sense. Now, you can pay zero tax if you buy a house, residential property from that ESOP proceeds. That goes even with the income your
Stocks.
clients are making, which is stocks, mutual fund. So if they are selling out the mutual fund and stocks, they can actually use this section because it says any long-term
Crazy.
capital gain. So it can be, that's what I said, foreign stocks also.
Crazy.
So irrespective of your portfolio amount, you going to save 15,625 if you are booking 1,25,000 rupees every year. On SWP, if you are retired and if you only have this capital gain income, you can save 5,25,000 of capital gain. So my long-term capital gain in gold, I have offset against my loss in equity shares or a mutual fund. That's allowed. You have any income except salary. If you have a loss in FNO, future and options, that can be adjusted against all this income in the current year.
So Nitesh, first of all, I am very excited for this episode, mainly because I have heard a lot of information on stocks. I have heard a lot of information on mutual funds. But first time, I think we have a guest like you who is also going to talk about investing and taxation at the same time. Because tax is something that is very complicated for everyday investors, including me, right? Even I don't understand, and you've obviously told me so many new hacks now. So I think today's episode is going to be awesome, only because I want to know all the different tax hacks that are there, whether it's in investing, whether it's F&O, whether there's a lot of other beautiful questions that we're going to cover, right? So that is what I want to understand. And we're going to look at investing also and how these two can get married with the perfect synergy to maximize my profits. So that is it. So again, first of all, thank you for coming here and giving your time because I know you're very busy, right? So I'm very happy to have you here.
Thank you so much, Shashank. It's my pleasure to be here. I personally like your content and always pleasure to interact with you.
Superb. So now we'll start going into like deep dive into all the stuff, right? Now, first things first, why do you think tax planning is very important in wealth management?
Shashank, when we look at any product, we look at the return also. That what return I will get out of that mutual fund, that PMS or stocks I'm investing. But what matter to me as an investor, what actually will go into my pockets.
Correct.
And that would be post-tax.
Correct.
Right? So if I just see that this product will give me X return, that's not relevant. Why? Because what is the taxation on that and how much you need to pay? So what matters to you is a post-tax return. So if I'm not combining these two aspects, which is your investment planning and tax planning, you will always have a lesser of what you are making.
Correct.
So that's why what we are trying to do with all the investor, and maybe you also emphasizing to your investor that how you getting and what you are getting post-tax, that only matters. Because see, your taxation is like gravity. You can't escape from that.
Dena hi padega.
वो देना ही पड़ेगा, right? Only two things certain in this world, death and taxes. We can't do anything about the death, but tax आप plan कर सकते हो.
Yeah.
So it's like gravity. Let's manage that. And if you plan for that, there are very good way after even the new regime, you can still minimize your tax liability. And specifically when you are investing, there are many ways to reduce your tax liability.
Okay, wonderful. So can we start learning a little bit more? Okay, I want to understand a little bit more about, let's say, how do we get tax adjusted return or risk adjusted return? Now, you said risk and tax, right? How do we marry the two? Investment and risk.
So see what happens. Normally, when we are talking about the investing, now we understand the risk and return are two sides of the same coin. And we want to have a good return, which is taking care of the risk. So what we are focusing, okay, is how is your risk adjusted return? Not only just risk adjusted return, tax adjusted return also, which exactly means that what I'm going to get from this product 10, 15, 20 years down the line, whatever may be the tax scenario, but can I plan in a such a way that I can think about that this will be a cash flow, even the post-tax. So that's what we are trying to analyze. So you invest into any product, be it a short-term, medium-term or a long-term. There are products available. It looks on surface, it's one and the same. But when you go deep down into that, thanks to taxation, even the gross return is same, but the net return after taxation can change a lot.
Okay. Okay. So you're saying I might not have to take a very high risk instrument.
Of course.
Because after tax, I might lose everything and it might be equal to a lower risk instrument I don't even know today.
Perfect.
Okay. Very interesting. And if I want to, let's say, invest, right? Whether it's short-term investing, let's put it that way. I want to do something for 3 to 6 years. I want to buy a house or some planning like that, right? How do I plan for this in a very tax efficient way that when I withdraw tomorrow, I don't pay a lot of tax, but I also want to build my house nicely. How do I do this?
Superb. So, Shashank, even if I go before 3 to 6 years, let me go and tell you, even if I just need money after 1 year, okay, where people are putting money?
Okay.
Mostly FDs?
Yes.
Right? Mostly FDs, or maybe they are putting in the liquid funds, which is your debt fund.
Correct.
Now, what if we can get the same return? A risk is also kind of same, okay, but your post-tax return would be higher.
How?
So let me show you the calculation.
Okay.
So let's say you want to invest for just 1 year.
Okay.
Okay. It can be anything. You just want to pay for your college fees, or you just want to pay for that house down payment. You just think of any goals. And mostly people are parking money in debt fund or FD. Let's say you're investing 10 lakh rupees in debt fund or FD. And you are getting a 7% return.
That's correct.
That's your 10 lakh 70,000 rupees after 12 months.
Correct.
Right? At 7% interest.
Yeah.
Now, on this 70,000 rupees of interest, you have to pay tax as per your slab rate.
Correct.
And Shashank, let's assume that you are in the 30% tax bracket.
Yeah.
So on this 70,000, you will pay 21,840 in taxes.
That's correct.
Okay. Now, let's take a case of arbitrage mutual fund. In the risk and reward types, it's kind of same as your debt fund.
FD. Okay.
Okay, or FDs. Right. Now, you also on the similar return as we just spoke, correct. 7%. Now, the return is same 10 lakh 70,000, but here comes the taxation. Because arbitrage fund considered as equity fund taxation, so you pay 12.5% tax if you stay investor for more than 12 months. Okay. So whatever gain you have, you just need to pay 12.5% because it's considered as a long-term capital gain. Not only that, as we know, first 1,25,000 of long-term capital gain is exempt. So in our example, on the 70,000 rupees of capital gain, you pay zero tax. So practically, you keep all the money, which is 10 lakh 70,000. Okay. So if you compare debt fund versus arbitrage, you are just saving 21,840 by just keeping money into simple arbitrage fund, no nonsense.
But I have a question here. So debt fund is also liquid fund and FD you have calculated. They both have taxation on this?
Same, yes.
Even
so
liquid
debt fund, after the 2023 taxation changes, also always consider as short-term capital gain. If you are investing in any kind of a debt fund, and you have to pay tax as per your slab rate, irrespective of your holding period.
Wow.
अब 2 साल, 3 साल, 5 साल कितना भी रखो. You whatever gain you have on your debt fund, it's treated same as your FDs.
Okay.
So your bond, your FDs, your debt fund has the same taxation.
Okay. And if I, let's say, remove this, if I invest in arbitrage fund and I remove it, let's say, before 365 days, then I have to pay short-term capital gains, which is 20%, which is still cheaper than 33% of with cess, whatever.
So even if you need money after 8 months, 9 months, 10 months, still the arbitrage fund can give the same return. Okay. And the tax, like you rightly said, it's 20% and not 30% like your slab rate in your other product.
And these are very liquid. I can withdraw whenever I want.
Of course.
There's no penalty like FD when I withdraw.
Nothing. So that's another liquidity aspect, right? If I'm doing FD, I need to do for a certain period.
Correct.
In arbitrage, let's say I don't need whole 10 lakh rupees altogether. I can remove just 5 lakh rupees, 4 lakh rupees, whatever denomination I want.
Correct.
I can just do that. So that's added advantage when I'm doing arbitrage fund. Of course, that's there in the debt fund also.
Yeah.
Against FD. But so liquidity is also a big point in arbitrage. So Shashank, honestly, anything about 6 months, there is no instance of negative return also in arbitrage. Or there is not too much of volatility.
Yeah.
So practically anything, you are in the higher tax bracket, it makes no-brainer that you can go in arbitrage.
Okay, so this was for 1 year, which is crazy because now I'm going to save 21,000, maybe even more actually, not just 21,000. Now, if I want to do something like this, as I said, for 3 years to 5 year time frame, I'm buying a house. This I'm going to use for my tuition fees. Abhi aayega sab, every kid has a tuition fee or some recurring expense next year aane wala. So this is a very good hack that I make whatever liquid fund type return, fixed, low risk, and I also save money, right? Now 3 to 5 years mein kaisa karna? How do I do this here?
So Shashank, what we are using for many of our clients, like that they want to make a down payment for the house.
Correct.
After 3 to 5 years, or they want to spend for their children's higher education. Now you don't want to take too much of risk. So people are again going for kind of a debt fund or a with 3 to 5 years of FD, or they are even going for a bonds. Nothing wrong if they are selecting that product with proper analysis. Okay. But what we have concluded when we are seeing this kind of a profile, what if we invest into equity savings fund?
Okay, what is equity savings fund? What's the difference?
So equity savings mutual fund is a type of a mutual fund. It's quite conservative. Practically, in this, fund manager puts money into 3 kind of a product. One is your equity, 1/3 is equity, 1/3 is arbitrage, and 1/3 is debt. Now, the beauty of this product, again, this is taxed as equity. Why? Because 1/3 is equity, which is your non-hedged or unhedged equity
And
portion.
2/3 is actually debt.
2/3 is debt, but out of that, 1/3 is arbitrage. Now your arbitrage is also considered as equity. And because of that, total money in equity savings fund are more than 65% money in either in the arbitrage or equity. That's why it has also got equity taxation.
Got it.
And typically, if you see the return in past, it's somewhere around 9 to 10% CAGR. So it is also beating your FD, even the pre-tax, and of course it will beat after post-tax. Let me show you an example in that also. So Shashank, as we see that, if you see the comparison between equity savings and debt fund versus FD or bond, whatever you take.
Yeah.
Let's take the same example of 10 lakh rupees. Let's say you're getting 8% return on debt fund, FD or bond, as the case may be. After 5 years, considering that you want to invest for 5 years, your total redemption amount would be 14,70,000.
Correct.
Okay. Now again, the issue is that on this 4,70,000, though you made a good return, but on that the tax would be 1,46,640, thanks to your slab rate taxation.
Wow.
Okay. Now let's go to equity savings category. Typical return, as I told you, we can expect. Okay, around 9 to 10%. Again, it's not fixed, but this is the return which we have seen in the past. So the total redemption amount is 16,10,000, which is of course higher than around 2,25,000 higher than the bond and FDs.
Correct.
Okay. And now the best part, you will pay 12.5% tax.
Correct.
So that's a good tax saving, which is 6,10,000 ke upar you pay 12.5% tax. But now again, you have that 1,25,000 exempt.
Correct.
So you only pay on the balance amount, and that taxation on that 6,10,000 is just 63,050 rupees. So another 85,000 roughly saving here. So higher return and low tax.
So I've not only made almost 1.5 lakh extra from my return perspective, but I've also saved 85,000 on the tax perspective.
Perfect.
So the more money is in my pocket basically right now, and I'm taxed properly and I've paid everything.
And this is what you have started with. This is the advantage of thinking, investing and tax planning together.
I think most people don't know this because a lot of people just invest in liquid funds and FD, right? I don't think people have heard about equity savings funds. Okay.
And also, Shashank, you can even consider the multi-asset fund.
They have the same structure?
They have a bit different structure, bit aggressive. Or multi-asset includes your any 3 asset class, equity, debt, gold.
Okay.
So that gives you that diversification also.
That's
your
nice.
asset allocation also taken care of. Or you can even invest into balance advantage or dynamic asset allocation fund. Why? Because the fund manager manages the internal valuation wise. They are managing how much should be in equity, how much should be in debt. But in all these 3 categories, the main benefit is that your equity taxation.
It's 12.5.
Just 12.5. You just have to keep more than 1 year, whatever you are investing, a better return in terms of risk adjusted, and also a better taxation.
But are you seeing a lot of people pay 33% tax today? Maybe a lot of your clients also?
Of course, Shashank, because see, after the new regime also, if you just see that people easily making 2 lakh rupees per month, which is 24 lakh rupees, even if you are paying, let's say 20% tax, 12.5% is still less. And we are not just discussing about even the 30% case scenario, it's a win-win. Even at 20% taxation, here you are just paying 12.5%. And that also after 1,25,000 rupees of capital gain exemption.
Okay.
So that's the win-win, I think. So if you are in the lesser than 12.5% tax, then only your debt fund FD makes sense.
Now I realized, because I was just thinking that why my CA didn't tell me this also, right? But because I've also put some in liquid fund and kept aside for other reasons.
Because
but then
Shashank,
they don't know investing. They're not.
perfect.
Yeah.
That's what I told you, that you need to combine your investing and tax planning knowledge.
Correct. Because CAs, they don't have the investing up to date with the investing changes that are happening. And if I want to do long term is simple. What we don't
see, if you are investing money into equity funds and all that thing, which people are widely putting, they are not touching up on this short-term goal because they think that mutual fund is only for the long term. That's what again we are highlighting here. For every need, there is an option available if you go a bit deeper. But of course, if you are investing in SIP or investing a lump sum, every month SIP what you are putting, you have to keep that for minimum 12 months.
Correct.
Because every installment of SIP is considered a fresh investment for taxation purpose.
Correct.
So today if I'm investing, that has to be in 12 months for a long term. Next month I put, that has to be 12 months from that month. So it's very simple over there. And of course, 1,25,000 of capital gain can be a good hack.
Got it. And I have one more question here. So can I park my emergency funds also, let's say, in arbitrage funds?
Of course, Shashank.
Is that a viable option?
Of course, Shashank. That's what we are doing with most of our client.
Okay.
Because see, when we are parking for a short term or emergency, we are following this mechanism of SLR. Safety, liquidity and return.
Correct.
Though I'm not too much focused on the return, but anyway, I know that out of your all emergency corpus, let's say you want to save for 5-6 months of your expenses as emergency, आप 2-3 महीने का पैसा रखो FD में या savings account में, I don't mind. But can you park the other half money into arbitrage? Because anyway you might not need to use it for next 2, 3, 5 years. Why to pay unnecessary tax every year? Because Shashank, even if you are putting money in FD and you are not taking interest out, still you have to pay tax on that every year because your 10% TDS would be deducted from that FD money.
Okay.
So your compounding also getting impacted. In my arbitrage, even in my debt fund, I don't need to pay anything unless and until I'm redeeming that. So why you want to pay tax even though you are not withdrawing money in FD?
Got it. And I heard one more strategy. I don't know, somebody on Twitter or somebody had posted this, where if they get a bulk money, right? Let's say I got 3 lakh today as a salary bonus. So what these people are doing, they're putting it in an arbitrage fund. And then from the arbitrage fund to their SIP.
STP.
Yeah, how does that, is that something you're seeing? What is that? Can you explain?
Right. So not only the bulk money, we also combine that with the valuation. So if we feel that equity has quite high valuation and client wants to invest the money, we are doing the STP route.
So first put in
arbitrage. Or even in that case, because if you just want to park in next 2 or 3 months, you can keep in the liquid also or even in the ultra short term also. That's not an issue. But we are parking either in a debt or arbitrage, and from that every month we are doing, or a weekly, STP into equity funds.
Okay.
Because you are tackling 2 issues. You are not keeping money in saving account where you earn just 2.5% peanuts.
Correct.
Here you are on 6 to 7% per annum, be it ultra short term fund or be it a arbitrage, plus tax advantage in arbitrage. Because you will just pay in short term also 20% tax.
Correct.
Because the money which is remaining in the arbitrage for next 3-6 months till the time you are doing STP, you can earn 7% return.
Correct.
So it's a good strategy. But still, within less than 3 months of option, we are not touching arbitrage because it can be still volatile.
Yeah.
So better to remain with ultra short or a liquid if the horizon is just 3 months.
Got it. Awesome. Okay, so now I understood this, which is a beautiful flywheel, right? If I'm doing it for 6 months, park it in arbitrage, get that extra interest and do STP, which is a smooth process. Now, a lot of people have this question because today most investors have come into the market saying, एक तो मेरे को 12% चाहिए हर बार, and मेरे को पैसा I want to double very fast, as soon as possible. And I know personally a lot of people go heavyweight on small cap, whatever risky asset is there, riskiest, they'll be like, I can take the risk, आप दो मेरे को, right? So double चाहिए. So can we break down this double concept in the market? If I'm doing SIP, what should my mental thought process be on doubling my money? When can it happen?
Very interesting, Shashank. Because we all, I think now know the rule of 72.
Yes.
So सबको वो तो पता है कि if I'm parking 10 lakh today and if I get a 12% return, it will double in 6 years. Though it's not guaranteed, but let's say 12% CAGR if you are getting on a particular mutual fund or equity and I'm parking 10 lakh today in that portfolio, in 6 years it will double. It's simple formula, 72 divided by 12% return, so it's 6.
Correct.
If you get 14-15% return, it will double in 5 years.
Yes.
That's very simple. So one of the investors came to me a few years back and said, Nitesh, hey, if I'm putting money into SIP, that will also double in 6 years. And that, though we understand that that's not going to happen because you are not putting all the money together, you are putting in a monthly fashion.
Correct.
Then I went back and did some calculation and we came out with one formula.
Okay.
Which is not available online.
Okay.
Because it's not too common. People are not thinking in terms of doubling the money through SIP. So we just did a back calculation that if I get a 12% return, we can showcase that chart.
Yeah.
So if I get a 12% return, okay, it takes 125 months to double your money through SIP. Okay, let's assume that you are putting 10,000 a month. You will put 12,50,000 over a period of next 125 months.
Correct.
So whatever you have invested in that 125 months, which is 12,50,000, after 125 months, you will have 25 lakh rupees because of 12% CAGR.
Okay.
So if you get 12% return, it takes 125 to double. If you get 10% CAGR, it takes 150 months to double. If you get 7%, which is kind of a RD kind of a product, it takes 215 months to double your money because, Shashank, you are putting money every month. It's not upfront like a lump sum. So it's as simple as that.
Got it.
But of course, it's simple but not easy. Because I need to stay put for next 125 months or 150 months.
To double the money. Which many people today don't have the patience to do that
90% of the SIP is getting shut in 3 years.
Yeah.
Within 3 years, 90% of the SIP is just getting shut.
Got it. Okay. Another question is, which is again a popular belief which I just spoke about, is that higher the risk, higher the return. Right? So I told you, a lot of people invest in small cap funds heavily. They're like, मैं 30 साल रखने वाला, I'm going to keep it for 30 years.
Everything in the small cap.
So everything is small cap. Anyway, over a period of time, small cap gives the best returns. So over 30 years, I should just stay invested in small cap. I'll take whatever drawdown comes because I know 30 years I'll make the best returns possible. Is that a good strategy?
So Shashank, problem क्या आ रहा है? People are feeling that risk है तो इश्क है.
Yeah.
But they took it very literally. Higher the risk, doesn't mean that प्यार बढ़ जाएगा आपका. Higher the risk doesn't mean that प्यार आपका ज़्यादा बढ़ जाएगा.
Yeah.
The same way, only thing guarantee when you are taking excess risk is that you will get excess risk, not the return. And I have a data to showcase.
Okay.
So because you can manage the risk, but not the return, right?
Correct.
Whatever we say in the wealth management, that what you have to manage the risk, the return is a byproduct.
Yeah.
Right? So higher the risk, I would like to emphasize here that higher the risk does not mean higher the return in mutual fund most of the times.
So do we have some data that tracks this?
Of course. This is the latest data, Shashank, of last 10 and 15 years of these 4 indices. Nifty 100 total return index has given 13.8 CAGR.
Okay.
Nifty mid cap 150 total return index 18.5 CAGR. Nifty small cap 250 total return index 15.8 CAGR, and your Nifty 500 is 14.7 CAGR. Now people blindly putting money into, let's say, small cap will realize that your mid cap has actually outperformed your small cap
In the last 10 years.
in the last 10 years.
Including the bull run.
Including the bull run
COVID bull
of
run.
all the small and mid cap rally, right? I'm not saying this will repeat it in next 10 years, but do we have the data when we are just blindly putting all the money in the small cap? And at what cost? Higher drawdown and lesser return. So ये तो उल्टा हो गया.
Yeah.
Higher the risk, lower the return. Not only that, let's look at the 15-year period. Your Nifty 100 is 11.7 CAGR. Nifty mid cap at 15.7. Nifty small cap again 13 CAGR. In 15 years also, mid cap has outperformed small cap. The interesting point here, Shashank, is that Nifty 500 at 12.2 CAGR, which is just 80 bips lesser than the small cap. And how much lesser risk you are taking?
Yeah.
In Nifty 500, it's hardly 20-30% in mid and small cap. Still, you get a best of both worlds, which is
Correct.
a good return, risk-adjusted good return, because you will have a lesser drawdown.
Yeah, because
or a
small
lower
cap drawdowns are heavy, right? It go to 30%, 35% sometimes. I think this time it went to almost 40% drawdown.
Of course. Shashank, in
whereas-
2008, when market collapsed by 40-50%, small cap went down by 70%.
Ouch. Nobody would have stayed invested.
Perfect. So now here I want to highlight one thing, okay, in terms of percentage also. What people don't look at this data, that is one thing. The second thing, Shashank, if I am having a 10 lakh rupees of a portfolio, if that down by 50%, which is 5 lakh rupees, in absolute term, we understand that 10 lakh ka 50% down is 5 lakh. But from 5 lakh to again go to 10 lakh, I need 100% return.
Which will take 6 years, as you said.
Of course. So this is what I'm saying, that are we looking in the percentage terms? If 20% loss, I need 25% return to get back to the capital.
Correct.
So one thing which particularly people should remember, that you should manage the drawdown. The return will come automatically.
Correct. Wow. Now, Nitesh, I have one more question here, because I see a lot of things on LinkedIn and Twitter. A lot of people talk about you can make good amount of return in the market and pay zero tax. Now, I don't know how much is real, how much is clickbait, and how much is actually doable for a common man investor. So now, if I am investing in the market, we've heard of some concepts, but how do we actually put it to use, and how can I really save a lot of tax? Because I want to plan ahead instead of planning much later. So can we see an example for that?
Sure, Shashank. And you might have heard me also saying that you can pay up to zero tax if you plan well.
तो वो सच है कि नहीं?
वो सच है. Because I would not do it for clickbait. Why? You know that? Because if something is not practically possible, I would never go on screen and say that.
Yeah.
And if I'm not utilized for my clients, again, I will not say that. So it's a first-hand experience. Not only that, before I share that concept, I would like to put that on a note and record that in 2018, the capital gain tax has reintroduced.
Correct.
2004 to 2018, there was no capital gain tax.
Correct.
Okay. 2018, one day after the budget, I came out with this concept in India, and that is our original article still exists, where we have said you can still pay no capital gain tax.
And what is I want to understand kitna investment pe no.
Perfect. So let me show you an example what we are talking here. And I'm not saying that in all the scenario you will pay zero tax, but to a great extent you can reduce your tax liability if you use this concept well, called profit harvesting. And we have written in extensively about that. Let me share that example so people can make a better sense of that. Okay?
Yeah.
Let's say there are two investors
Correct.
investing 5 lakh rupees today. Let's say lump sum for an easy calculation, and turning 10 lakh in 4 years.
Correct.
On this, Shashank, 1,25,000 would be exempt in the 4th year.
That's correct.
When they want to redeem this mutual fund for XYZ goal. On this, after 1,25,000 at 12.5% tax, they have to pay 46,875 in taxes. Now, this can be zero instead of 46,000. And this is the practical solution for that. Let's say you are investing 5 lakh. Now, ये 5 lakh से 10 lakh direct तो नहीं हो जाएगा.
Correct.
It will be a journey.
Yeah.
Of course, there will be up and down. Again, for easier calculation or simple example, I'm assuming that it's in a linear fashion. So 5 lakh will become 6,25,000 after 12 months.
Correct.
I'll go and sell this 6,25,000.
Whole thing.
Whole thing.
Okay.
So that's 1,25,000 of capital gain I'm booking. Now the benefit here is that because it's 1,25,000 rupees of capital gain, I booked in one financial year, there is no tax.
Correct.
I'll reacquire the same mutual fund. Or if I don't like some of the shares or mutual fund out of that,
you can change it.
I can churn it. Okay? Or I can do the reallocation. कि यार ये small cap बहुत बढ़ गया है, मुझे अभी mid cap चाहिए या large cap चाहिए. You can do that.
Smart.
Changes.
Okay.
Now the same mutual fund or the another bouquet of mutual fund what you are buying, basket of mutual fund what you are buying, the new cost would be 6,25,000.
Correct.
So for income tax purpose, your new investment cost is 6,25,000 and not 5 lakh. Why? Because you just sold that 6,25,000 of mutual fund.
So that transaction
which originally you invested at 5 lakh. So 1,25,000 is added to cost now.
And there's no exit load because you're doing it after 1 year.
After 1 year. Perfect. Okay. And also it's a long term because it's after 1 year.
366 days.
Perfect. So let's assume that in the second year and again you got a 1,25,000 profit, which is around 14-15% CAGR, which we are assuming for this example. So 7.5 lakh rupees is the redemption value, and the cost is 6,25,000, which is 1,25,000 of profit I have booked. Again that year I will not pay any tax. Why? Because 1,25,000 per financial year is exempt. Fast forward, you see in the last year, the value is 10 lakh. By the time fourth year you go and sell, after 4 years you go and sell, your cost for the income tax purpose is 8,75,000.
Got
so
it.
each year, what I'm simply doing, I'm booking 1,25,000 of a capital gain. By doing that, I'm saving 15,625 rupees per financial year per person. So that's thing which you can practically do. Now you be investing on your own, you are investing in equity, you are investing in a mutual fund. If you are not taking benefit of this, you are missing out on 15,625 tax at least.
So this is easier to do on a lump sum, but if I'm doing SIP, थोड़ा मुश्किल है because I have to track कि कौन सा दिन पे क्या किया था and then maybe redo it.
In that you can do after 3 or 4 years. You can keep doing this because by the time second or third year is over, your first year ka SIP would have completed 12 months.
Correct.
Right?
Correct.
And at that time you might need to also remove few mutual funds which is not performing.
Yeah.
So what we are doing exactly right now in a client, it's not just for the tax saving. We always see that tax saving is a byproduct.
Yeah.
I want to churn out few non-performer. I want to do the or rebalancing of assets. So we are using that to remove that non-performer or doing this asset
and everything
allocation.
at free cost.
And you are also saving 15,625. And Shashank, we are not just doing for one person in family. Let's say you're investing from your wife account, your parents account.
Oh.
If I can do in 4 account, that's your 62,000 rupees of tax saving per financial year. This is, people are underestimating. And this is all possible even after new regime. That has nothing to do with old regime and new regime.
Why are people not doing this? Is it because it's effort?
Effort. People need to take action. Many people are aware about that, but they don't know how to do it practically. Because what will happen? If I'm using emotion, that no, market abhi upar hai, I'll book the profit now and I'll buy after 2 days, 5 days, 10 days, or I'll buy after 1 month. You are losing out on compounding, or maybe you are losing out on that cycle which we are doing the purpose for it.
Okay.
In fact, let me give one more hack. You don't even need to redeem the mutual fund. If you are doing a mutual fund, you can just switch from equity fund to arbitrage fund, or you can switch from equity fund to debt fund.
Okay.
And you can re-switch it to equity fund. Because this switch transaction in mutual fund also consider as redemption and purchase. So we are doing this smart hack for many of our clients.
Oh, so you're saying at the end of the year, 366 to 377 days with buffer, you are not selling it, you're just switching it to maybe the same AMC's arbitrage or whatever, where there is no transaction, negligible or whatever the cost is. Then you're going there, so it's considered a sale there. And then you take it from here back into that after maybe a day, and you put it back as a new investment.
That's it. You don't need to even take out money in your account. So your psychology wala issue bhi, behavior aspect bhi also be taken care of, because you are not taking money in your account. But for income tax, it's sell and purchase.
Correct.
So you book that 1,25,000 gain or whatever may be, lesser than 1,25,000, and you save on.
And you keep doing that because it's incremental.
Of course.
So where does this stop? This stops at 10 lakhs?
No. So that's what I'm saying. Let's say your portfolio is 1 crore. But at least out of that 1 crore, can you book on the proportionate 10 lakh rupees this? Why? Because you just want to make sure that every year I am taking benefit of this 1,25,000 tax-free amount.
So ये साल का example ले लेते हैं. Let's say I've invested 10 lakhs and we've got maybe 3, 4, 5% or maybe even 1, 2% this year. So that basically becomes free for me almost.
Of course.
Because 10 lakhs pay, even if I get 2, 3, 4, 5%, even if it's less than 1.25 lakhs, obviously it is.
Yeah.
So I make a free gain of 2, 3%, which I'm again compounding it into my next without paying tax.
Perfect. This is what I'm saying. So irrespective of your portfolio amount, you going to save 15,625 if you are booking 1,25,000 rupees every year.
And partials भी कर सकते हैं,
of course,
partials भी कर सकते हैं.
Anything 1,25,000 there is no tax. Even if you go higher than that, but you get tax benefit only on 1,25,000. So let's say some year you want to book 2 lakh rupees of gain because of the adjustment, but you will just pay tax on 75,000.
Which is a very small amount.
Of course.
Which is only 12.5 on that.
But see, mutual fund is for long term, equity is for long term, but that does not mean I need not do anything for next 10 years to that fund, right? I also want to stay for long. This is my 10 years, 15 years goal. But can I do it every year or every 2-3 years whenever there is opportunity?
So money is anyway compounding.
Of course.
It's like one day that you're out of the market,
right.
Money is compounding, but you're saving almost 12.5% for that being out for one day.
Right. And if you have excess money, you put on the same day.
Correct.
If you have 5 lakh rupees in saving account, you buy that 5 lakh first and then sell. Who is stopping you?
Very interesting. Wow. Okay, I didn't think about this. Because this goes against the common theory that is in the market today that badal do aur bhul jao. Right. SIP forever. I mean SIP for long term.
Of course.
But this
well, one set it, forget it is for the equity as an asset class, but not for a product. As simple as that.
We are still anyway invested. Not
of
1 rupee is going out of the investment.
Of course.
We are just continuing that investment over time. Okay. So in fact, in bad years like this, it is even better, right? To do this harvesting is the best time to do it right now.
Right.
Okay. Wonderful. Now, apart from this, are there any other tax hacks that this is crazy? Is there something else that we can,
Of course, there are many and we have a full podcast on that. But of course, because...
Give me one or two good ones.
Of course. Because if it would be unfair if I just talk about the profit. Because in equity, we both understand. We have seen enough negative years and that red years, right?
Yeah.
Right now, we are seeing that time correction and many people are sitting in loss in equity, maybe in mid and small cap. Let me give you a practical example and what are other few things people are missing. Your loss can actually save taxes.
My loss can save taxes?
Yes. How that is possible? Let's say for many of our clients, right now, we have redeemed some part of gold holding because that has gone above certain percentage of gold we want to hold in the portfolio.
Correct.
ठीक है. So मान लीजिए gold में I have booked profit of 5 lakh rupees. That is long term capital gain we have booked in a gold mutual funds. Or it can be physical gold also. Now on this 5 lakh rupees of gain, Shashank, you have to pay 12.5% tax.
Correct.
Now my client told me, Nitesh, how we can save tax on that? Okay. When I opened his direct equity portfolio, there were 3 lakh rupees of a notional loss.
Not booked loss?
Not booked loss,
means
but a portfolio
he's holding something which has some loss.
Okay. We call it a notional loss in our technical language. Now, I told him, you sell these stocks. He like, Nitesh, no, this is well-researched stock. I don't want to sell it and all that thing drama. And I'm saying, I'm not judging you that you have not selected the good stocks. I'm just saying that if you want to lower the tax liability on this 5 lakh rupees of gold, okay, you sell these stocks and reacquire after 2 days again. He said, usse kya hoga? I told him, magic hoga. The loss in your stocks or a mutual fund, you can offset against the gold also. Many of my CA friends are not knowing this.
Okay.
Forget about the normal investors.
Including physical gold, you're saying?
Yes. There is no asset class restriction to offset the capital gain and capital loss. So my long-term capital gain in gold, I have offset against my loss in equity shares or a mutual fund. That's allowed. So in this example of my client, this is a real example. 3 lakh rupees of loss we have booked. And he again got the same shares. And few of the shares which he wanted to remove, he have removed. Okay. Now, he just paid tax on 2 lakh. Why? Because 5 lakh minus 3 lakh rupees of loss adjusted. And now, only 2 lakh pay 12.5%. So, this is a significant tax saving. So, each year.
But ये 2 lakh पे भी 1.25 आता है इसमें?
No, gold में नहीं मिलता है.
Gold में वो long term capital.
Only on equity mutual funds you get 1,25,000 benefit, not on gold.
But you can offset with equity loss.
Of course. And now, let's assume the other case scenario. If you book 6 lakh rupees of loss, the extra 1 lakh rupees of loss you can carry forward for next 8 assessment year. In future, whenever you have profit, you can offset. And because you are equity guy and you are doing amazing with the technical research and all that thing, let me share one more hack with your audience, which again, I would believe 99% people are not aware. You can adjust your F&O loss with any income except salary. So you have a FD interest, you have a capital gain income, you have a business income, you have any income except salary. If you have a loss in F&O, future and options, that can be adjusted against all this income in the current year.
Can you give me some examples of what it can be adjusted with?
For example, interest. Let's say you have done this year F&O. Let's say some client done F&O and he has loss of 2 lakh rupees. Okay. And he has a bank interest of 1 lakh rupees. Now only on 1 lakh he has to pay the tax. the other would readjust it.
Even if it's FD?
That's what I'm saying.
So FD interest will be cut.
FD interest. Let's say you have a 5 lakh rupees of capital gain and you are selling that capital gain, that mutual fund because you want to buy a house. Okay, 5 lakh you sold and 5 lakh rupees is a capital gain. But now you have F&O loss of 2 lakh rupees. You will just pay tax on 3 lakh rupees.
Wow.
So your F&O loss can even adjusted against any income except your salary.
So F&O loss would be mostly short-term capital gains, right?
No. So your F&O, again, many people are not aware, Shashank, your F&O loss is considered as business loss.
Even if I'm an individual, it's considered as a business loss.
So let me share this chart.
I'm trying to understand, let's say F&O income, you said is business income. It is not short-term capital gains, obviously not long-term. But business income, even an average person who's not a business, right? As a guy sitting with IT job in TCS.
True.
Can he also do something like this to save tax? Is it allowed?
Of course. Why? Because when you are dealing into stocks, let's say you are buying today and selling also today, that's intraday.
Yes.
That is considered as a speculative business income. That is one thing. If you're buying today and selling today, that's your intraday. Okay. That's your speculative business income. That can only set off against speculative loss. So your intraday trading and profit and loss can only be adjusted against each other.
Intraday only.
That's your intraday.
Okay.
Now let's come to F&O. If you are dealing in F&O, that is considered as your business profit or business loss, not your capital gain. Many people has this misconception. That's not a capital gain. When you are dealing into F&O, future and option, that's your business profit and loss. And let's assume you have some loss in that. And by the way, when it considers business profit and loss, the tax you have to pay as per your slab rate and not 12.5% and 20%. That's another thing I wanted to clarify.
Profit also will be.
Right. And now let's come to loss. And that's the beautiful, because 93% of the Indians have loss in F&O.
Correct.
And that's what's quite relevant. Any income except salary. You can see this. Any income except salary. You have a non-speculative business loss, which is your F&O loss.
Correct.
Any income except salary in the current year.
Okay.
Let's say you have 5 lakh capital gain. You have another business income of consulting income of 5 lakh rupees, or just consider any other
some moonlighting income
moonlighting income, or consider interest from FD.
Okay.
Name it, except salary. Okay.
Except rental income आता है इस पे नहीं.
Rental income भी आता है.
Rental income भी आता है.
Only salary को हटा दो. Any other income you have, आपका business का जो loss है, you adjust.
Okay.
And pay tax only on the balance amount. Now whatever is the leftover loss, समझो last year का leftover loss है in my F&O. That can only be adjusted against the business income.
Last year,
so there are two things I'm discussing. In this year, I have done some F&O, and in that I have a loss.
Okay.
In this year, I have other income. I can set it off.
Okay.
But I'm carry forward some loss.
One more lakh loss of carry forward.
Now that can only be adjusted again any other business income.
What is considered as business income?
So now let's say I am into professional service and I am charging fees to my client. Okay. Against that I can adjust.
So no interest पे नहीं आएगा, rental income पे नहीं आएगा.
Next year नहीं आएगा, current year में आएगा.
Okay.
This is the only difference. So there is called carry forward loss. Only carry forward पे याद रखना है that you cannot adjust against any other income. Only any other business income you can set it off. That's the one thing to remember. And when it comes to which we were discussing, the gold versus equity, there is one simple rule to remember, that your short-term loss can be adjusted against short-term or long-term capital gain.
Correct.
But if you have a long-term loss, it will not be adjusted against short-term capital gain, but long-term के सामने कर सकते हो. So your short-term is anyway you can adjust, but your long-term loss has to be adjusted against long-term capital gain. Shashank, if you just remember this, and now you have this detail in front of you, right? You can gonna make best out of your profit and loss both. That's the hack. And trust me, if you can execute well, you can reduce your liability like lakhs and crores over a period of next 10-15.
So let me ask you one question.
Please.
Now, realistic scenario में करता हूँ. Let's say that in the month of Jan, Feb, March, our market fell quite drastically. We had 25 to 30% drawdowns. Most of us have seen in the portfolio, whether mutual fund, whether non-mutual fund. Now, you're saying if I had sold those companies at that fall, and they were not doing well, and I had sold it and rebought it 2 days later, I would only incur the charges, right?
Perfect.
Whatever the charges are, which will obviously be lesser than whatever my tax component was. And then I rebuy it. And then that loss, obviously I'm not going to sell it again because then everything went up. Market is back up today. I've not sold it yet. That loss can be carried forward to my either other profits that I made in the same year, or I can carry forward it for the next few years as well.
8 years. So either adjust or carry forward for 8 years. So that will be adjusted against your future profits.
Future long term. So that same stock when I book in the future, I don't have to pay tax.
Of course.
If I had
to the
done,
extent whatever loss you have.
But if I had done buy and hold, I would have had to pay On even 1 lakh profit, I have to pay tax.
And that's the whole point. So again, we are coming to the first question we have started with. Include or combine your tax planning and investment planning. Whatever
Aage
you
ka
are doing.
socho,
Aage ka
not
socho.
1 year.
And how you can do this year. So we are doing this podcast at right moment, Shashank, because till March, whatever adjustment you have to do, you can do it. Because March is the end of financial year. So if you still haven't done this or don't know anything about this, this is your reminder to do it.
But is there a
March.
problem here? Let's say I book lot of loss. ऐसा government आता है पीछे?
No, of course not. Na. That's the genuine loss, na, Shashank.
Yeah.
Because see, that's the loss.
Genuine loss.
Genuine loss. Or even if you are just going to save for your capital gain, they cannot stop you. Why? Because you are not doing tax evasion. See, there's a difference between tax evasion and tax planning. If I'm telling you in front of lakhs of people, I'm not telling you tax evasion. Even if I'll not tell you in the closed door. Why? Because tax evasion is not recommended at all.
Correct.
Because today or tomorrow, government will catch you. So we were very vocal about that. Don't do political donation. In last 3 years, whoever done the political donation, all people got the notices.
Correct.
So that's your tax evasion.
Yeah.
What we are saying that 1,25,000 exempt, book that.
So people do this usually in March ke aspas, they do it quite late, right? Is that correct?
So people are first of all not doing that. But don't think about the March. You have to do when it's the right time in your portfolio.
Like 30% down है तो कर दो फिर you're...
आपको लग रहा है that you want to get out of some loss-making company which is not good, do that. But use that loss smartly. And this is how you can do. But if you know the rule, then only you can do that, Shashank.
A lot of people don't get scared to book the loss, right? They don't feel like they should book the loss.
Of course. That's again
Psychology.
the behavioral bias that you're the loss aversion, right? Because people think that if I'm booking the loss, I'm accepting my mistake. But that's part of your journey, right?
Yeah.
Even you being a professional fund manager, you know that some of the picks were not right. That's okay to come out of that.
Rebuy it and play the game again.
Of course.
Okay, understood. Beautiful. So we've spoken about gold offset. We spoke about this offset as well, which is very good, the short term, long term, and we spoke about this. So beautiful. Now I want to ask something else for same tax saving only, because I want people to save money after watching this. I know a lot of my friends who are sitting in these big IT companies. They have something called RSUs and they have something called ESOPs.
Of course.
Right? They find it as very complicated structures. One of two reasons is when to exit, when I exit, how much to exercise price, ye price. Confusing hai, but they pay a lot of tax when they exit these RSUs. Is there a way to save a lot of tax with RSUs and ESOPs?
Many of our clients on ESOPs and RSU paid zero tax. And again, I'm mentioning
Not clickbait.
Not just...
Okay,
and I'm saying zero tax. We have many clients across your Alphabets, Amazons, and Nvidia, and few of the Lenskart and the Physics Wala and all that companies also, right?
Correct.
They've just recently came
IPO'd.
out with the IPOs, right? Now, first of all, let's see that how the ESOP and RSU taxation works.
Yes.
There are two instances of taxes.
Okay.
The moment you exercise that ESOP, you get the rights, and
Correct.
there is a time that you can exercise this ESOP. Exercise is nothing, but you get that in your demat. Let's simplify that, right?
Okay.
So that would be charged to tax as your salary income. Let me tell you as a number also. Let's say the stock's fair market value or market price is 100 rupees. And you got that stock for a free because you are employee of that organization.
Correct.
Right? So for you have not paid anything to acquire that share. Tax department says this 100 rupees benefit you got, Shashank, because you are working with that company. Otherwise, if I want to go and buy, that's 100 rupees. It's costing me 100 rupees, right? So that 100 rupees is your salary income. You pay as per slab on that.
Yeah.
Honestly, you cannot do anything about that. You have to pay that tax. Let's say you are paying 30% plus whatever surcharge on that. So on 100 rupees, you have paid the tax because you exercise that shares worth 100 rupees market value or fair market value.
Correct.
Now let's assume that after 1-2 years, fast forward, that shares went up to 200. And now you want to sell that. If you sell that, okay, first let me tell you the rule and how you save the tax. If you sell that 200 rupees stock, for you, now the cost is 100 rupees. Why? Because you only 100 rupees you already pay the tax. Na? So government can't say now that your cost is zero.
Correct.
Because they already charge tax on 100.
Okay.
So your cost is 100. You are booking profit at 200. So 100 rupees is capital gain. Now on this you have to again pay 12.5% tax because 100 rupees is capital gain. But now you can pay zero tax if you buy a house, residential property from that ESOP proceeds.
First house?
First, not even first, you can even have the second house with that rule.
Okay.
That's called 54F.
And up to what limit is this?
Sure, I'll tell you. So 54F is the section number. It says that any long-term capital gain you have and you utilize the whole net proceeds, which is in our case, the whole 200 rupees into whatever shares you have invested buying residential house property. Okay? You pay zero tax because this is a capital gain exemption under section 54F.
Okay.
And the limit here is 10 crore rupees.
Okay.
So
10
up
crore
to 10 crore rupees of house you are buying, let's assume that, okay, you pay zero tax. So what we are doing now, the practical approach I'm telling you, okay, when client comes to us, they have many goals like financial freedom, buying a house, funding their child's educations and all that thing. If they have ESOPs, we ask them to wait for 4 or 5 years. When you want to exit from this ESOP, that's the ideal time to buy a house. And that's why all the more important to do the tax planning along with your financial planning and investment planning. So Shashank wants to buy a house now. He can of course very well afford and can buy. But if you want to stay for a rent for 2, 3, 4 years, you maximize on the rent what you are paying in the taxation. At the same time, after 3, 4 years, when you exit from that ESOP, you buy the house, so you don't pay any tax. So this is about the planning. And if you plan well, you can actually pay zero tax.
Okay. So 1 or 2 questions here, just from an understanding standpoint.
Please.
Do you have to stay in that house what you buy?
No, that's the residential property you have to buy. That can be for investment.
I can put it as rent also?
Of course. What tax law says, you have to buy a residential house. And you also asked me that it can be first house. No, even if you hold one house in your name, this can be for second house also. But if you already hold 2 houses in your name, then you cannot buy third house with this benefit.
Okay. So
that's the only thing.
You're saying it might be my 4th house that I'm buying, but I only have 2 houses at the given moment. Is that also works?
In
or is it
your
only
name,
first 2 houses?
At any point of time,
At
when
any
you're
point
buying
of time.
this, you should not hold more than 1 house property. As simple as that.
That's crazy.
Future में आपने 3-4 house लेके बेच दिया, that does not matter. But as of now, when I'm utilizing this section, I have to have only 1 house maximum in my name. And not only that, after booking this profit, within 2 years also you can buy the house, because this is not something that आज मैंने ESOP बेच दिया and tomorrow I'll buy the house, right? So government gives you 2 years after or 1 year before. So if somebody is watching the podcast, okay, and bought a house before 6 months and selling ESOP now, can still save the tax.
A lot of rich guys who are watching this with crazy RSUs. I think you're going to save some money after watching this. Oh, this is crazy. So is this the reason why in that 2021, 2022, a lot of people were buying expensive houses everywhere because they were all coming with good wealth in LTCG?
Of course, that can be one of the reasons. And also naturally, when you are getting this bulk of wealth out of ESOPs and RSUs, right? That always goes towards upgrading your lifestyle and the luxury purchases and all that.
Mostly into assets only.
Right. But why I'm again mentioning that if you know about this planning and if you don't hold more than 1 house, that can be a win-win situation. Because many people already have the house, then they will not be able to utilize this section. And that's what I'm saying, that plan well.
And then now same thing, if my wife also has LTCG and then she can also...
Perfect.
So 2, 4.
Do not recommended so many houses. But
but it's all legal. There is no problem with
of course,
it is legal, right? That's what
legal,
you're saying. So I can have 2 houses as an investment from LTCG without paying even 1 rupee tax.
Right.
My wife can have 2 with LTCG without paying a single rupee tax. If there's a working couple, so they can actually build 4 properties by just offsetting LTCG with Section 54F.
Perfect. And so that's not because we ask for the ESOP and RSU, that goes even with the income your clients are making, which is stocks, mutual fund. So if they are selling out the mutual fund and stocks, they can actually use this section because it says any long-term capital gain. So it can be, that's what I said, foreign stocks also.
Crazy. Now I want to give you one realistic scenario.
Please.
Okay, I want to buy a house in 5 years.
Okay.
Now you're telling me, first go with either equity saving scheme or anything, whatever your basket is. Every year do tax loss harvesting with this, what you said, so that we can save 1,25,000. So sell it at the end, rebuy the units again, or don't even sell it. Just do a systematic transfer plan to an arbitrage fund and put it back here. And then you save that 1.25 and you pay less tax. Cut to 5 years, 6 years, your corpus builds, your compounding happens. 5-6 years later, let's say I'll pay some smaller amount of tax than I would have paid more. But now I want to go buy a house. I go buy the house as well. Don't have to buy it instantly. I can still buy it 2 years later.
Of course.
So you're saying I can even sell the mutual fund and then buy 2 years later and just keep it in some arbitrage fund if I want to, right? I'll pay the tax on that.
Of course.
But that LTCG on that, I don't have to pay.
Right.
Then I will go buy the house after maybe 2 years so that I get another 7 plus 7% return. And I don't pay any tax on all of this. And I can do this twice.
Of course. So now you know that where your money is going. And you can actually envision that how you want to utilize this money.
And all this is for individual only.
Individual. Of course.
Corporate mein to aur bhi game hai. Okay. Nice one, guys. Okay. Superb. Okay, now I want to ask one more question, like a myth buster actually.
Okay.
Because we spoke about numbers and percentages so much, right? Lot of people say that Shashank, market mein I want 12% return every year, and this is a very irritating problem that people are telling me also, that why is the market not giving 12% every year? For some rhyme or reason, everyone thinks ki 12% aana chahiye. And 1-2% aata hai to they're like, how can we do 12%? So what is your take on this myth? That because you have clients, they might be asking you the same question.
Of course. It's everywhere the same scenario. Okay.
Yeah.
But one thing we have realized over a period of my own investing journey since 2008, and since last 8 years we are managing clients. Okay. One thing is very much sure is that investing is 80% about psychology and 20% about maths. You also realize that over a period of time, right? When we are investing, अपने पे भी आता है वो psychological pressure, or when we are handling clients' money वो भी आता है, right? Now, why I say that? Because first of all, how that 12 or 15% figure came, I don't know. Why I'm saying that I don't know. Whenever people comes, that they come with that mindset, hey, Shashank, I need 15% return, 18% return. On what basis people are thinking? So first I need to highlight that to our client or our viewers, that how to expect that what kind of return you can get from equity.
Yeah.
So there are many formulas around the world. One or two things which we follow is that what is your nominal GDP growth?
Yeah.
If your nominal GDP is growing by 12%, let's say your corporate profit is also same, and you get around same return. That's the one theory. And of course, the practical aspect, look at the expected return. So in India, the nominal GDP is growing by 12%.
Yeah.
Okay.
Yeah.
Actual GDP plus your inflation is your nominal GDP. Or other way around, Shashank, if we take, what is your GSEC? Government security is giving you 6-7%.
Yeah.
Okay. On that, you get 5-6% risk premium.
Yeah.
Because if you get 10-15% risk premium, which is 18-20% people are expecting, then nobody is going to put money in FDs or government securities or any of these bonds and all that thing.
Yeah.
Everybody will get 20% return. Then there would be no, I would say, economic balance.
Yeah.
And that's how not the economy works. So first of all, I need to be very much prepared that what is my GSEC rate.
Yeah.
And on that, based on history, I can get 5-6% risk premium.
Yeah.
That's how I'm coming to that 12% rate. Now, if I'm getting that 12% return over a period of long term, that does not mean every year I'll get 12%. So one of the things which when we onboard the client, we share with them is this, and you will love it.
Yeah.
But before we talk about that, whatever people are viewing right now, imagine that your height is 6 feet. I think your height is actually 6 feet.
Yeah.
So your height is
almost.
Your height is 6 feet, and you want to cross a river which has average depth of 4 feet. Okay, I repeat, your height is 6 feet and you want to cross a river which average depth is 4 feet. Okay, and you don't know swimming, let's assume that, and you want to walk it. And I asked my client the same thing, can you cross the river? Okay, Shashank, 90% of the people told me, yes, we can cross because my height is 6 feet.
Average is 4.
Average is 4. I will cross it. Then instead of telling anything, I showcase one thing and I want to show it to your viewers also.
Sure.
Can you cross a river with average depth of 4 feet? You can see the screen, right?
Yep.
So when I say average depth is 4 feet, you and me understand, and many other people also understand, the law of average. Okay? It giving you a delusion that it's 6, it's 4, 4, 4, 4, 4. No. Some point of time, the river depth can be even 8 or 10 feet.
Yeah.
And at some point of time, when you're just starting to cross the river, it can be even just 1 feet. Okay? And see, this is how it look like. So all the people who think that, who can cross the river, will not be able to.
Yeah.
Because at some point of time, the depth of the river can be 8, 10, 12 feet also.
Correct.
So one needs to remember this simple aspect. When we talk as a fund manager or investor advisor or just MFD, whoever is talking about this concept of average return, we need to emphasize to our client that average works in this fashion, Shashank. When I say 12% return or you say 12% return, that's not our fault, or that's not even their fault. Their mind gives a signal that 12, 12, 12, 12, 12, 12, 12. No, it's not going to work like that. It can be -5, 22, 4, 13, -17, 57, 10, 19, -12, 29. Still the average is 12% CAGR. And this is how the sensitivity index works. That's your Sensex. If it's a linear, then you and me don't need to pitch client the mutual funds or PMS or stocks.
Yeah.
Every Tom, Dick and Harry will be buying equity.
Correct.
Because it's about this journey.
Yeah.
And that's why the expectation mismatch happen. Because people are coming with a mindset कि यार 2020 से 2023 के बीच में 18% रिटर्न बना.
Yeah.
I can get 18%, but 18% figure आ कहाँ से रहा है?
Yeah.
So what is the realistic return you need to assume? And please know that this is how the average works. In last 1 year, you got absolute nothing return.
Yeah.
So this is a period where you get a single digit return or no return or minus 20%.
Good. Yeah, that means something is coming up.
Of course.
To re-rate the average.
True.
Interesting. Okay, now I have a question on gold because we touched a little bit about gold in the previous example. What is your take on gold? Because abhi everyone's talking about gold, everyone's talking about silver, everyone's like invest in gold, invest in gold. I know I went to a Tanishq store recently and it was sold out. The gold coins were sold out. And insane, right? It's a gold rush as they call it. Yes, there is talks on geopolitical, central banks buying and all. But what is your take on gold?
So Shashank, before I tell you what is my take on gold, I want to showcase the data.
Okay.
Because if I just give a gyan, it's of no use.
Okay.
Because let me show the data.
Okay.
Because in God we trust.
Yeah.
But for all other, must bring the data, right?
Okay. Yeah.
Let me share a data. Okay. From 2012 to 2019, I got married between this, so I know the exact gold price, by the way. So,
okay.
2012, the gold price is 31,000. 2013, the gold price is per 10 gram, 29. 2014, 28,000. 2015, 26,000. 2016, 28,000. 2017, 29,000. 2018, Shashank, gold price is 31,000. So 2012 to 2018, you got zero return on gold. Let's go one more year, which is 2019. Gold price per 10 gram is 35,000. The CAGR between 2012 to 2019 is 1.5%. Now somebody will say that, hey, Nitesh, this is one of the instance. Let's go to 1992 for 10 years. From 1992 to 2002, you again got 1.5% CAGR. 10 saal ke baad, you got almost zero return on your gold. Okay. The price in 1992 was 4,300. In 2002, the price of gold was 4,990, which is less than 5,000. So from 5,000, we are at 1,25,000. Awesome.
Superb.
Only point by sharing this data is gold has price correction. Even if not so sharp price correction, though there is price correction also, it has a long period of subdued return or a time correction. Okay, which we are seeing. And I gave you two examples of 8 years and 10 years. I'm not just talking about 2 or 3 years. In equity, you will also see 1-2 years of time correction. But this is 8 and 10 years of time correction. So my point here is that if you are buying gold out of FOMO and just looking at last 2 or 3 or 4 years return, and you rightly said many factors like geopolitical crisis, all the World Bank are buying gold.
Yeah.
After COVID, all this has shaped up differently. Okay. So this might be few of the reason that gold has performed like mad rush.
Yeah.
But I don't know if this is a pick or not, but we have started lightening on the portfolio of client of gold. Because see, you and me might not share or anybody will not share the physical gold.
Yeah.
They are holding. Okay. But whatever gold we have got as ETF or mutual fund, we already started booking profit. The reason is simple. If you see the gold to Sensex ratio, last 10-12 saal ke, one of the low point pe hai. And at any point of time, the gold to Sensex ratio is less than 0.75. Currently at 0.68. So at any point of time, gold to Sensex ratio is less than 0.75. The probability says is 2 years Sensex return, 80% chance of Sensex delivering more than 14% CAGR. Again, I'm not predicting anything. I'm just sharing the plain data point. Shashank, why I'm sharing first data point and now my view? I'm saying don't buy gold. Absolutely not. We are buying in our clients. We are suggesting our clients to have the allocation in gold, but it comes as a hedge. It comes as managing your overall portfolio balance. Okay, but it's a growth asset. I don't still believe it's a growth asset. So don't go overboard on that. Up to 10-15% allocation in your overall portfolio, good. But have it as a digital gold. When I say digital gold, mutual fund, ETF, or maybe SGB. Why? Because this gold you can always use for rebalancing. So right now we are selling out few of the gold and buying equity.
Correct.
So this transaction you can only do if you can see your gold portfolio in mutual fund and all that thing and not in your locker, because that you're not going to touch.
Okay.
So this is the point we are talking about the gold.
And you're saying now when the gold that you're booking in your clients' accounts, you're also offsetting with the losses that has happened in the last 1 year of Nifty.
That's what I'm saying. Always combine the tax planning and investment planning and link to your goal. You're gonna make best out of all the world, not just both.
I think most CAs don't know this also, right? Some obviously know.
Of course, Shashank, because see, if you ask me if I am a practicing CA, I don't know many things about the investing. Even in CA, there are internal audit, there are tax audit, there are indirect tax, there are many fields.
Yeah.
Okay? Why we just practice the tax planning and investing? Because this itself a niche area.
Got it. Superb. Okay, perfect. So I'm going to ask one last question now because I think we've got some insane amount of information. Yeah. So one last question. What is your take on SWP to save taxes? Because I think that is the last step. Abhi, you've told me how to save money, you've
Everything.
told me how to grow money. Now I want to retire and take my money out. And a lot of people are now coming to the concept of SWP. How do you play this?
So let me first tell you the tax planning wala. Okay. On SWP, if you are retired and if you only have this capital gain income, you can save 5,25,000 of capital gain.
Okay.
Right now we were just saying 1,25,000. Now I'm saying 5,25,000 of capital gain and you can pay zero tax.
Okay. How?
On your SWP.
Okay.
Before I go to that, the taxation part, now I want to tell you, because I'm just wearing my investing hat again, most of the SWP calculation and all the reels I am seeing on the social media, most of them are nonsense. Sorry to say that, but that's the fact. Why? Because unrealistic return expectation from the SWP, and they are putting this in an Excel and they are expecting that this is going to happen, that 12, 13, 15% return on mutual fund
every year
when you're investing. And when you are withdrawing also 10, 12, 15% return.
Correct.
So people are just making thesis on this. So it's a wrong and it's a misselling of SWP. That is first thing. But with the proper planning, how we are telling the SWP to our clients and why it makes more sense, let me showcase few data points.
Yeah.
So Shashank, again, this is one of the most practical and useful calculation on SWP you would ever see. Okay. 50,000 rupees of SIP can give you 26 crore. And that also with very conservative and a proper planning. 50,000 rupees of SIP can get you 26 crore of corpus.
Over a period of?
Over a period of 20 years of investing and 30 years of withdrawal. Now, let me tell you how it works. Let's say a person is doing 50,000 SIP. In 20 years, just 50,000 SIP, no top up and all that things here. I don't want to complicate that. 50,000 SIP for 20 years. The corpus would be roughly 4 crore. I'm assuming 11% CAGR. Fair enough?
Yeah, not even 12.
So 4 crore corpus. Now, I'm asking, when you have that 4 crore, don't expect the 11% return. Why? Because Shashank, you want to withdraw out of that. You cannot expect a 20, 30, 40% drawdown in your retirement years.
Correct.
Make sense? So I'm expecting 9% CAGR after 20 years. So whatever 4 crore corpus I have built, let's assume a 9% CAGR and start SWP. Only 4% of the total corpus. So 4 crore ka 4% is roughly 16 lakh. So don't withdraw more than 4%. Most of the RM and other bank guys are saying that you withdraw 8%, 10% because that's the return. Absolute nonsense. Trust me, which is not practical. Okay. So SWP for 30 years, 9% CAGR is what I'm assuming. How much you will withdraw in first month is 1,35,000. Okay. Fast forward, every year you will start withdrawing 5% more than what you withdrawn last year. Because you and me will retire, but my inflation will continue.
Correct.
Right?
That's what, yeah.
Nobody is putting this into the calculation. They are just assuming you will withdraw the same amount, which is again not practical because I need higher and higher amount as the inflation number of years goes because of the inflation. So I start with 4% of 4 crore, which is roughly 16 lakh. I keep withdrawing 5% higher than what I have done in 30 years. Shashank, I will withdraw 10.8 crore.
And then the corpus is over.
Not over. At the end of the 30 years, you will have 16 crore. So 16 crore at the end of 30 years, which is total 50 years, 20 years of investing, 30 years of withdrawal. 16 crore corpus left at the age of, or let's say at the end of 30 years, and 10.8 crore you have withdrawn. So 10 plus 16, 50,000 SIP to 26 crore with a proper assumption. This is what I'm trying to tell you. Now, is this interesting?
Yeah.
Makes sense?
This is interesting,
right?
yes.
Now, let me tell you the taxation part because I'm combining the taxation part here. Let me tell you, somebody is withdrawing every year 10 lakh rupees.
Correct.
Okay, just for easier calculation.
Correct.
Now, out of 10 lakh, what I want to withdraw in my retirement here, let's say I don't have any other income and only this capital gain income because out of this 10 lakh, let's assume 5 lakh rupees is my capital and 5 lakh rupees is of capital gain. Fair assumption?
Yeah.
Because when I withdraw from any mutual fund or shares or I'm doing SWP, that has one element of capital, which is I've invested, and one element of profit.
Okay.
Now let's assume 50% is cost and 50% is profit, which is 5 lakh each. Now, if I don't have any other income, I don't pay any tax. As per current tax law, 5.25 lakh rupees of long-term capital gain is exempt. How?
5.20.
How? The capital gain of 1.25 lakh is exempt, which we know. But 0 to 4 lakh, there is no income tax.
Correct.
Right? So that basic exemption limit also can be used for this long-term capital gain. So you don't pay any tax.
So basic exemption limit can be used for long-term capital gains if you don't have any other income.
And I'm assuming that I only have the passive income of this capital gain. So on 5,25,000 of every year, you pay zero tax. So this can be the nice strategy that how much I want to withdraw. I can take off tax planning and also have a fair assumption on my SWP. You can never go wrong.
So this can be used by people's parents today who are 60 plus.
Of course. Because if they don't have any other income and they are withdrawing 10 lakh rupees, 12 lakh rupees, but the capital gain is lesser than 5,25,000, not a single penny tax they need to pay.
Interesting. I think एक थोड़ा बैठना पड़ेगा साथ में बाद में ये podcast के बाद to understand more on.
I'll come to Bangalore.
Yeah, I think about business taxation also we have to figure something out. But again, Nitesh, I think this was crazy, man. I think even if I had to sum it up, I've already seen more than 5 plus 2 plus, I mean, almost 10 lakhs and above if I know how to optimize it well. And this is something I feel that a lot of people in India don't optimize well, right? And I don't blame anybody for it because it is a complicated subject. I myself don't know half the things you told right now because my job is to focus on my business and make money. And में वो March के आसपास I will cry a little bit saying गया इतना too much of tax खड्डे में जा रहा हूँ ये सब. And then we go back to April where I have to start working again for 3 months for the government and 9 months for me, right? But I think now I'll work 1 month less for the government and only 2 months for that. But again, thanks a lot, Nitesh, for coming and simplifying this and obviously showing some great examples. So I really appreciate it. And thanks a lot, man, for this podcast.
Thank you so much, Shashank. My pleasure and glad connecting with you and discussing all this.
Thanks a lot. And guys, I'm sure you'll have a lot of questions because I know there'll be some questions people will have. You can put in the comment section. I'll ask Nitesh whenever he's free to give me a list of answers and then we can put it back on the comment section as well.
For sure.
Okay. Thank you, guys. Thank you.